The 2008 financial crisis was a pivotal event that sent shockwaves through the global economy. In this video, we'll discuss the factors that led to this crisis, its far-reaching consequences, and the measures taken by the U.S. government to mitigate its impact. The 2008 financial crisis was a major economic downturn that began in the United States and quickly spread worldwide. The trigger was a combination of factors such as the collapse of the U.S. housing market, high-risk loans from banks, and the transformation of mortgages into intricate financial products. Due to the decline in home prices and numerous homeowners failing to make mortgage payments, the value of mortgage-backed securities dropped significantly, resulting in substantial losses for banks and financial institutions. This caused a credit crunch as banks hesitated to lend to one another or to individuals and companies. The crisis resulted in the collapse or near collapse of numerous large financial institutions such as Lehman Brothers, Bear Stearns, and AIG. In order to avoid a total breakdown of the financial system, the U.S. government and Federal Reserve implemented unprecedented measures such as bailouts, loan guarantees, and interest rate reductions. The crisis led to significant outcomes, such as a sharp economic downturn, elevated joblessness, and a decrease in consumer expenditure and investment. It also resulted in greater oversight of the financial industry in order to avoid future crises. But what exactly happened, and why did it occur? To understand the crisis, it's important to know how mortgages operate. When an individual chooses to purchase a home, they usually do not have sufficient funds to pay for it in full at once. Instead of that, they take out a significant loan from a financial institution or a creditor. The mortgage is a type of loan with a contract that requires the borrower to pay back the money and interest within a specific time frame, typically 15 to 30 years. This implies that every month, the homeowner pays a sum that is allocated to both the loan and the interest, thus slowly accumulating equity in their home. If a homeowner faces financial challenges and is unable to pay their mortgage, they are considered to be in default. In this scenario, the bank is permitted to repossess the house by engaging in a procedure known as foreclosure. It is worth noting that the bank which provided the mortgage frequently sells it to other financial institutions or investors. This implies that homeowners may discover their mortgage being handled by various companies throughout the years, causing confusion in some cases. Gaining insight into these fundamental aspects of mortgages can shed light on the way the crisis developed, as numerous homeowners encountered difficulties that resulted in widespread defaults and foreclosures, causing significant issues in the housing market. Previously, getting a mortgage was a major obstacle for people with poor credit or unsteady employment. Lenders frequently hesitated to authorize loans for these borrowers due to perceiving them as high risk, concerned that they might fail to make their payments. Nevertheless, the scenery started to change in the 2000s as investors sought fresh chances to increase their profits. They acknowledged the potential of the U.S. housing market, seeing it as a more profitable option than typical safe investments such as treasury bonds. The increasing fascination with real estate resulted in a sharp increase in mortgage loans, even for individuals who would have been rejected before. Large financial institutions created mortgage-backed securities to take advantage of the high demand for them. Fundamentally, these assets were formed by combining numerous individual mortgages and offering them as investment bundles to willing investors. This method enabled lenders to transfer the risk of individual loans and enticed investors with the potential for greater profits. The attraction was powerful, particularly with the increasing home prices, portraying these securities as a secure option. This change in the mortgage industry ultimately altered the way individuals obtained home loans and played a role in the swift growth of the housing bubble at that time. The housing market was booming, and investors were eager to make money. They began putting money into mortgage-backed securities, which are packages of home loans that are sold to investors. With the increasing number of individuals purchasing these securities, the need for mortgages also escalated quickly. In order to meet this need, lenders started providing loans to individuals with limited funds or poor credit history. These mortgages were referred to as subprime. Some lenders took it to the next level and participated in predatory lending practices. Loans were distributed without verifying if the borrowers were truly capable of repaying them. They also provided adjustable rate mortgages that appeared to be within reach initially, but eventually proved to be too costly for numerous individuals to repay. Credit rating agencies kept giving high ratings to risky mortgage-backed securities despite their role in evaluating investment risks. Their ratings were determined using outdated data that did not account for the recent increase in risky lending practices. This helped investors feel secure and motivated them to continue purchasing these securities, despite their high level of risk. As the cost of housing increased drastically, it caused a bubble that wasn't able to be sustained in the long run. A lot of individuals borrowed money to purchase houses, but when they struggled to make their monthly payments, a wave of defaults started. This resulted in an increase in the number of houses on the market, with a corresponding shortage of potential buyers. Due to an abundance of homes on the market and decreased buyer demand, home prices began to decrease substantially. This decline in home prices had serious consequences for many homeowners. Many of them found themselves in a situation where they owed more on their mortgages than the actual value of their houses, a scenario commonly referred to as being underwater on a mortgage. Certain homeowners chose to cease making payments entirely, resulting in an increase in defaults and a continued decrease in prices. Financial institutions that had made significant investments in high-risk subprime mortgages experienced substantial losses, causing a chain reaction across the economy. The scenario escalated into a critical situation, impacting not only homeowners, but also banks and the housing market as a whole. The complex financial instruments called collateralized debt obligations, CDOs, and credit default swaps played a major role in exacerbating the financial crisis of 2008. These tools were similar to costly gambles on the success of mortgage-backed securities. When the housing market collapsed, these wagers proved to be calamitous, leading to massive financial setbacks for banks and investors. As a result, numerous prominent financial firms, such as Lehman Brothers, became insolvent, while others had to consolidate with more robust companies or request assistance from the government to survive. This chaos caused a surge of fear that spread across the economy. Credit markets, crucial for accessing loans for businesses and individuals, unexpectedly came to a standstill, creating obstacles for obtaining funding. Simultaneously, the stock market experienced a sharp decline, resulting in a notable decrease in investment value. This series of occurrences led to a significant economic downturn in the United States, resulting in widespread unemployment and financial struggles for millions of individuals. The crisis showed the risks of complicated financial products and the interdependence of the worldwide financial system, impacting how we approach and oversee financial markets currently. In reaction to the financial crisis, the U.S. government implemented crucial measures to stabilize the economy and avert a total collapse of the banking system. The Federal Reserve took one of its initial steps by offering emergency loans to troubled banks. This was essential as it ensured that banks had sufficient funds to function and keep providing loans to businesses and individuals. Furthermore, the government implemented the Troubled Asset Relief Program, TARP, with an initial allocation of $700 billion aimed at stabilizing the financial system. Even though only $250 billion was initially allocated for rescuing banks, the initiative was later broadened to include aid for other significant industries, such as car manufacturers and insurance giant AIG, in addition to providing relief for homeowners at risk of losing their homes. In order to enhance the financial system, the government carried out stress tests on large banks. These assessments assessed the ability of banks to manage economic recessions and financial crises. The government's goal was to enhance transparency and create trust among investors and the public by determining the financial stability of banks and identifying those in need of additional capital. This initiative played a crucial role in building trust in the financial system by showing people that banks were under close scrutiny and measures were being implemented to guarantee their stability. In general, these measures played a crucial role in facilitating the economy's recovery from a difficult period. The Dodd-Frank Act, which was approved by Congress in 2010, was a major financial reform law designed to increase transparency and stability in the banking system. The Consumer Financial Protection Bureau, CFPB, was created by the law to safeguard consumers against unfair, deceptive, or abusive behaviors in the financial industry. More openness in the trading of financial derivatives was also necessary, as they were viewed as a factor in the 2008 financial crisis. Furthermore, the legislation established a system for major banks to collapse in an organized way, called the Orderly Liquidation Authority, to avoid reliance on taxpayer bailouts. Although the Dodd-Frank Act was a positive move forward, there continues to be discussions on whether the regulations implemented are enough to avoid any potential financial crisis in the future. Some believe the law didn't adequately tackle the root problems of the 2008 crisis, while others think it has imposed excessive burdens on the financial sector and may cause unintended effects. So, what did we learn from the 2008 financial crisis? One key lesson is the danger of perverse incentives, where policies encourage risky behavior. Mortgage brokers, for example, received bonuses for issuing more loans, which led them to approve risky mortgages that ultimately hurt profits. Another topic to consider is the idea of moral hazard, which occurs when organizations assume increased risks due to the expectation that another party, such as the government, will face the repercussions. The concept of too big to fail effectively describes this notion. When banks anticipate being rescued, they are less likely to refrain from risky actions. The 2008 financial crisis was a multifaceted and complex event that involved multiple sources of blame. The government's lack of effective regulation led financial institutions to take excessive risks due to greed and poor decision-making. However, ultimately, this crisis was caused by humans, stemming from the choices made by people and organizations. Thank you for tuning in. If you found this video to be useful, please show your appreciation by liking it and maybe even subscribing to our channel for future informative content. Stay updated and look after yourself.